The sort of phrase I use is whole of life cover is there to protect you against the assets that you will die living in and living off. Beyond that, I would really recommend term insurance, because when you look at the overall annual premium outlay, whole of life cover is 3 times more expensive than term cover to age 90. So when it's much better, in my view, that people get the protection that they need, and you don't want to buy something that isn't going to be useful, but term insurance absolutely is useful for those assets that you're going to move down.
Hello and welcome to this Fireside Chat. I'm Sonia Raj, Deputy News Editor at FT Advisor, and I'm here with Holly Hill, Director at John Lamb Hill Oldridge. Hi Holly, thanks for joining me today.
Thank you for having me.
So something that a lot of advisors are navigating right now is the IHT changes that are coming in and kind of pensions falling under it. So what are some of the kind of overarching things that advisors should be looking at right now?
So obviously I'm from a specialist life insurance brokerage, so we use life insurance really primarily as a liquidity management tool, so that people who die with a large estate IHT liability, and most of them will owe that money to HMRC within about 6 months from the date of death, they often don't have the liquid cash to cover that bill. And so they use life insurance quite a lot, so that basically you provide a death certificate, your executors will provide the life insurance company with a death certificate, and the money will be paid out directly, pretty much directly to HMRC to cover that liability. And that allows the probate process to continue and much more swiftly get people sort of their estates wound up at a time when really, a death can be, is always a very significant moment in people's lives. And so it's quite nice if that administration is a lot easier.
Yeah. And a lot of the time advisors sort of use whole of life, obviously. And yes. Where do you think they may be going wrong, or perhaps could be developing further?
Yeah, so I think whole of life cover has a really huge part to play, and actually specifically now that pensions are falling under the IHT regime, I think we will see a lot more whole of life cover going in force, and that's primarily because it's guaranteed. Mm-hmm. You know that it will pay out, and if the premiums are affordable, and you build them into your cash flow, you know what your premium will be every year, so you know that you pay that and you will get X amount out at the end. And for pensions, which a lot of clients are very frustrated that the pensions are now taxable to IHT, because it was seen as this pot of money that could be used to pass down wealth to your children and to look after them once you've left. But now, obviously, that's going to be subject to 40% tax. And of course, once your children inherit it, they're going to pay income tax on their withdrawals. So you're facing quite a high potential tax charge on that money. And so whole of life cover can be a really good solution to that. You can draw down from your pension, use that money to pay for whole of life insurance, and you know that you've effectively repackaged it up again as a fixed thing that will go to your children without the burden of the 40% IHT. Where I think whole of life cover is sometimes overused is purely because it's extremely expensive. It's the most expensive of the options. And term insurance can be an alternative, much more cost-effective part of estate planning. So often what we say to high net worth clients, for ease of numbers, let's say they come with a £5 million IHT liability. You might say, well, if we think about how these assets might be gifted over time, maybe your children are 30 or 40 or whatever, you might be able to gift them some stuff in your 60s, in your 70s, 80s, all the rest of it. Those assets that you're able to pass down the generations can be covered very effectively with term insurance, because you have a 7-year tail on your gift at the moment, 7-year tail on the gift. So if you take out term cover to age 80, that will protect the asset while you hold it, and if you gift it by the age of 73. Similarly, term to age 90, you can have gifted it by 83. And the majority of our clients do a lot of transferring in those sort of 80s and 90s years, 70s and 80s years. So the reliance on whole of life cover doesn't need to be so high.
Yeah. So where would, I guess, whole of life play a role versus term, and when do you think clients could end up overpaying? So obviously the example you've given is really great, but then where does whole of life fit in?
Where does it fit in? Yeah, absolutely. So the sort of phrase I use is whole of life cover is there to protect you against the assets that you will die living in and living off. Beyond that, I would really recommend term insurance, because when you look at the overall annual premium outlay, whole of life cover is 3 times more expensive than term cover to age 90. So when it's much better, in my view, that people get the protection that they need, and you don't want to buy something that isn't going to be useful, but term insurance absolutely is useful for those assets that you're going to move down. So you have to be a bit careful, because you don't want to insure yourself on the term length, essentially, because if you find that you have significant later life care costs, you might regret the fact that you had sort of took out insurance on the proviso that you'd pass these assets down, and now you find you can't. So whole of life, absolutely, it's the only guaranteed solution, so it absolutely plays a role. I'm not against it at all. I just think it can be used as part of a portfolio rather than sometimes being the only thing that you rely on.
That's really helpful to know, and I think for a lot of advisors that may be something that is worth considering for their clients, depending on a case-by-case scenario. Are there any specific types of term cover that you think would work better than others, or kind of?
So not really, but the only thing that I am not a fan of is reviewable premium contracts. I think that when you're doing IHT planning, if you're the kind of person that needs to be doing IHT planning, you've probably got a lot of other stuff going on in your life. You're maybe running a property portfolio or a company, or you've got several advisors involved. My view on it is that life insurance should be the bit that is stable and fixed and known and easily planned into the rest of your model, because there are lots of other moving parts. Our bit doesn't necessarily need to be. So reviewable premium contracts start cheap and get more expensive. That's can be useful for very short-term cover with the potential for the need for long-term, but you're fairly sure it's going to be short-term, so you're not going to end up with those higher premiums at the end because you're going to cancel it. But where you're not convinced that it's just short and you're trying to put long-term proper strategy in place, I'm very, very against reviewable premiums.
That's really helpful. And in terms of, a lot of clients obviously will have legacy plans in place, and advisors will maybe be reviewing them or kind of looking to see where they can go. So what are some of the things they should look at for those plans that are already in place?
Yeah, so I think there's a big cut-off here. So from 2013 onwards, life insurance became incredibly simple following the Retail Distribution Review. And now the contracts themselves, you pay a premium and you get the money if you die. You have no access to value inside the contract during life. If you cancel it, it's gone. Pre-2013, and there were a lot of these, I look at policies from the 80s and 90s for some of our estates clients. They're much more interesting in a way. They've got investment elements, they've got different sort of premium rates and investment rates going on inside them. And so quite a number of them will have built up what is called a surrender value, but it's effectively a cash-in value that you could access during life. It's really helpful if you are taking on old contracts for a client that you look at all of the policy details. So sometimes the insurance companies aren't very good at telling you what's actually inside the contract. Their record keeping isn't brilliant and their paperwork is sometimes even worse. So it's really important to get that breakdown of what the contract's currently providing and also what the contract has been doing in the past. So you can see quite well, if you look at the last, say, 10 years of premiums paid and the sum assured, whether the contract is performing well or badly. I mean, in the investment world, a snapshot is never as useful as the sort of overall picture, right? It's the same with the insurance contracts. So I think it's just something to be aware of, that sometimes we've done restructuring jobs where people took life insurance out a long time ago. It's got a huge surrender value, and actually they can access that money now and replace that contract, which was often a whole of life policy, with a term and whole of life kind of portfolio that I talked about earlier, and the premiums are funded by the investment of the money that you got out of that old contract. So it becomes a very neat structure, and it works for a lot of people.
And I guess when it comes to families and couples, what are some of the key considerations that advisors should be taking with regards to single and joint life policies?
Yeah, so basically, I mean, really the rule is for inheritance tax planning that if your will is going to say that all of your assets benefit from the interspousal exemption, the liability will arise on the second death. So you buy a joint life second death cover. That's fairly straightforward. Equally, where any assets are going to go passed down to the children or go immediately into a trust, your spouse doesn't have the right to have them on your death, you are looking at a single life liability, single life cover. There are certain things you can do. So often people take out what's called joint life first death, which is for mortgages, so that if one of them dies, the mortgage is paid off for the surviving spouse and that kind of thing. But for an inheritance tax position, really it just needs to match the terms of the will. I think what's interesting is that in joint life contracts these days, there's actually a lot of flexibility built in. And so when you're talking about families and intergenerational planning, you might think, well, I'm going to take out, £1 million of joint life cover, but I actually plan to give half of my estate down to my children in 20 years' time. Well, modern joint life second death contracts have things like gift carve-out options, which you've started off with a joint life policy, but when one of the couple makes a gift, the liability is transferred to a single life liability on them for 7 years. With the gift carve-out option, you can take that £1 million policy and scoop a bit out of it and move that onto a 7-year decreasing basis on that individual single life. So it's really great for long-term planning. If you haven't tied yourself into a contract that is inflexible, if you then go on to make gifts, that option is available to you.
That's really interesting because I think that's something I'm not familiar with for sure. And being able to do that carve out it must be quite life-changing for a lot of people, I imagine.
Yeah, I think it's just very helpful for understanding that when I talked about earlier about guaranteed premiums, our bit, the life insurance, should be the bit that you can rely on. So knowing that if you put a policy in place, it's got the flexibility to allow you to do further planning later without having to buy new policies when you're older and potentially less medically well is really, really helpful. The other thing that people really like is when they're doing in big estates, they also have a separation clause on the joint life contracts as well. And that's really helpful so that if a couple sadly does divorce, you can split the joint life policy into 2 single life policies without the need for further medical underwriting. So if you have become ill or whatever, you don't need to tell the insurance company. You've locked in your insurability effectively.
Yeah.
So it'll be repriced on your age, but you can create that into 2 single life policies. Again, massive flexibility. And also, the sum assured typically can follow the terms of the divorce settlement. So if one party's kept 70% of the assets, they can keep 70% of the insurance.
That's really interesting because it's something I personally wasn't familiar with. Maybe the viewers will be, but I definitely wasn't. So really helpful information.
Yeah.
I think finally, looking kind of ahead, what should advisors be looking at or kind of planning for when it comes to high net worth clients and their overall estate planning and protection?
So I think there's a few things. If I was to onboard a new client into John Lamb Hill Oldridge, I would look at their existing arrangements. Is there any restructuring that needs to be done? So if you've got huge cash-in values, can those be given back to the estate and cheaper premiums found elsewhere? So definitely look at the existing cover. You don't want to over-insure either. So there's no point in taking out further cover if you've got some. And be wary because people forget what they've got because they took it out 40 years ago. So look at that. Then obviously you have to address their current needs and all the rest of it. And then I think it's, from my perspective, it's just looking at taking stock of what the actual long-term estate plan might be. How old are the children? When can the gifts maybe happen? And then can I maybe use a bit of term insurance here to fill that short-term gap so that I'm not buying everything on a very expensive whole-of-life basis, or indeed leaving myself quite underinsured because I feel like I can't afford a huge whole-of-life policy. Well, I can afford some term insurance as well, and then if we sort of stick to the plan and I gift down as I intend to, then that sounds perfect. Yeah,
so it seems like going to term versus whole of life is probably quite a good idea for a lot of people.
Yeah, absolutely. I mean, as I say, absolutely whole of life has a role to play. It's invaluable. And we see lots of people going, do you know what, Holly, I understand your thoughts about term insurance, but I can afford the whole of life and it's guaranteed and that's what I want. And that's absolutely fine. It's not a, I'm not against it. I just think that it's important. It's better if you're sort of in your 70s and 80s and you did, die at that point, that you had the insurance in place. And if you can afford the term aspect, what I wouldn't advise people doing, I would never advise people to underinsure the term length. So if you kind of say, well, I could afford all of my liability to age 70, well, that's a terrible idea because you will probably live beyond 70. The average life expectancy is 84 and high net worth clients is probably higher. So I wouldn't advise that at all. We'd always prioritise securing the correct amount of long-term cover, and then if you can't afford it, dialing it back. And I'd start with whole of life and work back, not start with term and go up.
Yeah.
Because the whole of life is the only one you can guarantee a payout from. So it definitely has a role, but I just think the portfolio side of things can help people be fully insured.
Yeah, definitely. And it seems like there's a lot of other options out there which perhaps are not widely recognised. So that's been really helpful. Lastly, I guess, are there any sort of products or features that you think, I know we mentioned the carve out, are there any others that advisors should know about or be considering?
Yeah, so the other one that I would mention is gift into vivos insurance, so gift cover for the 7-year tail. So quite often you can buy a packaged product which effectively gives you a level premium every year for 7 years. You pay the life insurance effectively a surcharge for doing that packaging for you. You don't need to. You can actually do 5 term policies that are staggered. So you'll have one running for 3 years, 4 years, 5, 6 and 7. And each of those, if your IHT liability is 40%, each of those 5 will be worth 8% of the insurance. So for 3 years, all of them will be running and you'll have all of the IHT. And then after 3 years, one of them will fall away. So you'll have 32%, which is your IHT liability. So we stagger it like that, and it's often much cheaper to do it that way rather than buying a packaged product.
That's really helpful. Thank you so much. And I think, unfortunately, that is all we've got time for today, but I really hope that it is definitely proven useful for me. So I hope it has been useful for all the advisors and some really interesting takeaways. So thank you for joining me today and coming in and speaking with us. And thank you, of course, to all of those watching. For all your latest news on investment, mortgages, protection and pensions, visit ftadvisor.com. See you soon.